Types of stock traders. There are several types of stock traders, each with a different approach to the market and investment goals. 1. Day traders, who buy and sell stocks within the same trading day, seeking to profit from short-term price movements. 2. Swing traders, who hold stocks for a period of 1 to several days, seeking to profit from intermediate-term price swings. 3. Position traders, who hold stocks for several weeks or months, seeking to profit from long-term trends in the market. 4. Momentum traders, who buy stocks that are showing strong upward momentum and sell them when the momentum begins to wane. 5. Value traders, who look for undervalued stocks that they believe are poised for a price increase, based on a company's fundamental financial metrics. 6. Scalpers, who make multiple trades in a single day, seeking to profit from small price differences and volatility. 7. Algorithmic traders, who use computer algorithms to make trades based on predetermined rules and market data. The choice of which type of trader to be depends on personal preference, market knowledge, and risk tolerance, among other factors. Regenerate response. Day trading is a type of stock trading where positions are opened and closed within the same trading day. It is a high-risk, high-reward strategy where traders aim to take advantage of short-term price movements in the market. Day traders typically make multiple trades in a single day and close out all positions before the market close. This strategy requires a high degree of discipline and deep understanding of market dynamics and technical analysis, as well as the ability to quickly react to changing market conditions. Day trading is suitable for experienced traders who can handle high levels of volatility and have the capital to withstand potential losses. Swing trading is a stock trading strategy where traders hold stocks for a short period of time, typically 1 to several days, in an attempt to profit from short-term price swings. This is done by identifying stocks that are trending and entering a position at a low price, then selling at a higher price when the trend shows signs of reversal. The goal of swing trading is to capture intermediate-term gains rather than trying to hold a position for long-term appreciation or making multiple trades in a day for short-term gains. Position traders are individuals or firms that hold onto securities or other assets for an extended period of time, often several months to several years. They aim to profit from long-term price movements and shifts in the underlying fundamentals of the assets they hold. Position trading is a type of investment strategy that requires patience, a long-term view of the market, and a comprehensive understanding of the assets in question. It is often contrasted with short-term trading strategies, such as day trading or swing trading, which focus on quicker and more frequent trades. Momentum traders are individuals or investors who focus on buying securities that have had a strong recent price performance, with the expectation that their momentum will continue. They often rely on technical analysis and trend-following strategies to make their trades. This type of trading is considered to be high risk, as the security's momentum may suddenly shift or reverse, causing significant losses. A value trader is a stock trader who seeks to buy stocks that are undervalued, based on the company's fundamental financial metrics such as earnings, revenue, and book value. The goal of value trading is to identify companies that are trading at a lower price compared to their intrinsic value, with the expectation that the market will eventually recognize the company's true worth and the stock price will increase. Value traders often use fundamental analysis to evaluate a company's financial health, management quality, and industry conditions to determine if a stock is undervalued. They may also consider macroeconomic factors, such as interest rates and economic growth, that can affect the stock market as a whole. Unlike momentum traders who focus on short-term price trends, value traders generally have a longer-term investment horizon and are willing to hold on to their investments until the market recognizes the company's value. A stock investor is an individual or organization who invests in stocks with the goal of generating long-term wealth or income. Stock investors buy shares of publicly traded companies with the expectation that the value of these companies will grow over time, resulting in capital appreciation of the stock. Additionally, some stocks also pay dividends, which provide a steady stream of income for the stock investor. Stock investors often take a buy and hold approach and hold on to their investments for several years or more, rather than frequently buying and selling. The success of a stock investment is dependent on a number of factors, including the performance of the underlying company, overall market conditions, and the investor's individual risk tolerance and investment strategy. Algorithmic traders, who use computer algorithms to make trades based on predetermined rules and market data. Algorithmic traders are individuals or firms that use algorithms and mathematical models to execute trades automatically in financial markets. The algorithms they use are designed to make rapid decisions based on market data and execute trades with high speed and efficiency. Algorithmic trading is increasingly popular as a way to trade large volumes of financial instruments in a systematic and automated manner. When trading is important that traders know what's the PDT rule. The PDT, Pattern Day Trader, rule is a regulation implemented by the U.S. Securities and Exchange Commission, SEC, to protect retail investors. It requires any individual who conducts 4 or more day trades within a 5-day period in a margin account to maintain an equity balance of at least $25,000. The purpose of this rule is to prevent individuals from excessive and risky trading activity in the stock market. If the balance falls below $25,000, the trader may be restricted from making further day trades until the balance is restored. Traders can consider alternative strategies such as 1. Swing trading, holding on to positions for longer periods, typically for several days to several weeks, instead of day trading. 2. Trading in a cash account, trading in a cash account instead of a margin account, as the PDT rule only applies to margin accounts. 3. Increasing equity balance, maintaining an equity balance of $25,000 or more to avoid being classified as a pattern day trader. Multiple brokerage accounts is another option. If you like this content, please subscribe for more videos.